Welcome, Josephites. Thank you for joining us for the Jannah Speaker Series session. Today, we have a Josephite, Rajan, joining us from the East Coast to help us learn more about the macroeconomic impact and managing your financial wellness during this pandemic. My name is Anika, and I'm from the ISC 2009 batch St. Andrew's House, and I'll be your host for the session. A special thank you to the entire working committee of Josephites from across the US who have worked tirelessly on several initiatives like this speaker series, which will be rolled out during 2020. Logistics for today. This session will be recorded. All participants will be on mute, and you should turn off your video feed so we don't have any bandwidth issues. In case your video was set to turn on automatically when you joined, please turn it off. All participant questions will be sourced from our Jannah LinkedIn page. Please post your questions there. The agenda for the next hour would be as follows. Thomas Takatella will update us about Jannah's mission and the initiatives developed by the Jannah Working Committee that will be rolled out during 2020. Giridhar Nayak will tell us more about the Jannah Connect initiative. Jimmy Anklesaria, our MC, will introduce and interview Rajan and moderate the Q&A segment. This will be followed by closing comments and the announcement of the next speaker series session. We'll conclude with singing our school song. Thank you again for joining us. I'll now hand it over to Thomas.
I can hear them, but I do not see it. I can hear them.
Okay, Thomas, are you there?
Yes.
Can't they see me?
I think there's some. Hi all, Thomas Takatella, St. Andrews, batch of 77. The Joseph's Alumni Association of North America, or JANA's, primary purpose is to reconnect and reinvigorate the OBA of North America. We are doing this through a combination of social and professional networking programs. Each of these programs is designed to benefit each of us professionally, as well as support our school's future growth. So the Jannah initiatives that are now being rolled out are the following. The first is the speaker series, which started off with a bang with Rahul Dravid. It was followed by the COVID-19 health talk. And today we have the COVID-19 macroeconomic and financial wellness impact talk. The second initiative going on is the Jannah'mentoring Program, which has been started for our alumni and recent graduates in the US who may be interested in career guidance, career choices, and beyond, which would be supported by mentors who have been working and living here for a longer time. The third program is the Jannah Entrepreneurship Program, a new, exciting program where we will be helping entrepreneurs get some of their ideas off the ground and running through an entrepreneurship panel that would provide guidance and go all the way through fundraising and the growth of entrepreneurship ventures, because there's a fairly large group among us who have been there and done it before. So those are three programs that are underway right now, and we'll hear more about each of them in the coming days. As I mentioned, the primary purpose of Jannah is, again, to reconnect the OBA in North America, as well as to support our school's future growth. To that end, we would also have a Jannah endowment to support the school and its programs for future generations, including student scholarships, as well as faculty grants to recruit and retain the best staff. Jonah has the full support of the Bangalore Jesuits Educational Society's leadership, school's principal, and the OBA Bangalore leadership, who continue to provide us thoughts and advice on where we're going. I'll turn this over now to Giridhar to talk about the Jonah Connect. Giri, over to you.
Thank you so much, Thomas. Hello, Josephites. My name is Giridhar Nayak. I am from the batch of 2006 ICSE and 2008 ISE. I was in St. George's House. I hope you're all having a great start to the weekend. It gives me immense pleasure to announce the launch of the Jonah Connect podcast for our Josephite community. All Jonah Speaker Series sessions will now be available on the Jonah Connect podcast on Spotify and Apple Podcasts. Our Jonah volunteers have worked tirelessly to ensure that Josephites across the world and their friends and families can benefit from the highly relevant content that the Jonah Speaker Series has. Make sure to go on Spotify and Apple Podcasts and search for Jonah Connect. That is JAANA space Connect, and subscribe to our channel to be in the know of the latest developments in the world of technology, entrepreneurship, public policy, economy, sports, arts, and many more. We'll be in touch with more details of the podcast. Thank you so much, and we hope we'll see you more of you. Thank you. Over to Jimmy and Ash for the rest of the show.
Good morning, Josephites. Thanks so much, Thomas and Nanaga and Giri for that good introduction. Let's get on with the show. We've got a fantastic opportunity today, and like typical Josephites, typical Bangaloreans, typical Indians, you get something for free, which would have cost us thousands of dollars. We're thrilled. So we've got Ash, Rajan. Hey, stop this Ash. Okay, his name is Ashok. All right, these guys in America can't pronounce Ashok. Can you believe that? But I was just telling Ash, right, Ash? It's kind of funny how we come here. Luckily, my name was Jimmy from the day I was born, and maybe it was named after the family dog or whatever. But Jimmy. But it's funny because in India, we come to America and everyone changes their names, and even today on the call centers, you call someone and they'll say, "Hi, I'm Sue," and it's actually Shashidharan or something like that, And I was just telling Ash before we started, right, Ash, that how did your name go from Ashok to Ash? And you kind of feel like, hey, who is someone to change your name? And I think you said it was Maria Bartimaeus who is currently at Fox and at that time probably at CNBC or whatever. And so Ash can tell you that story. But I said, how different are we? Not at all. Because I remember growing up and every servant we had who had a rather long name, okay, from today you're Mary, that's it. So delighted to have Ash with us. Rather than read out a bio from him, I thought, Ash, pick up the action. You would have been class of 1976, correct?
That is correct,
so
yes.
You're a little kid, you're 5 years my junior, but that's okay. Tell us, first of all, start with the Josephite story. What was life like at St. Joseph's? When did you start? When did you leave? And quickly take us through, where did that little kid from St. Joseph's, naughty little fellow, I know you said don't say you were at the top of the class because that would have been a lie, but nevertheless, how did that kid go from there to this celebrity, who's so well renowned on the, Wall Street Journal? Okay, let's go.
Jimmy, thank you for that introduction. But it sets me up and takes me on a nostalgic trip back to school. I recall distinctly Monday mornings, which were my most painful mornings, only because I had to get there by bicycle 3.5 miles from home and still have my stockings not sag on me. Because Father Francis and Father Furtado would look at the sag ratio on stockings to keep you in the assembly or not in the assembly. So that was a massive pain point for me Monday morning. And then I have to keep the school song in the right alto and tenor in the hot sun till Father Furtado was convinced we had the right momentum to that song. So, but, those are small little tweaks of being awkward or unpleasant, but then there are remarkably pleasant memories. I remember one of my highlights, Jimmy, when bell ringer Mathai actually had me pull the bell string.
Hey, get your facts right, okay? You're a Wall Street guy. Facts have to be right. It was Matthew, not Mathai.
Matthew,
Mathai
okay.
was the chemistry guy.
Was his right-hand man. He was hovering around too. Okay. So bell ringing was a nice highlight for me. Going to Weeds, and I thought Weeds was the old Steve Jobs. I mean, his product innovation and his
Widdy, you mean Abdul Widdy?
Widdies, yes.
Yeah, and the younger generation call his son, well, his son took over and he became Abu. So today, if you said right? Widdies, the guys in the 70s and earlier would know Widdies was that little tiny hole in the wall at the very corner. And
that would be me.
Yeah, that changed to Abu. Just for context, these younger guys may not know what we're talking about because we're dinosaurs.
The mixed feelings about Widdies for me. My grandparents were very disciplined and very strict. So the concept of pocket money was lost on them. So I would show up very little in my pocket at the Widdies hole with a massive appetite for the stuff that was on array. But the key I learned at a young age, in order to generate an impulsive loan, you got to have some collateral. In other words, if the total came to 1 rupee 60 paisa, you should at least have 60 paisa. Then you could ask someone spontaneously for the 1 rupee to make
up. We call that leverage, right?
There you are.
We
so I
invented
might start the first debt crisis many years ago at St. Joseph's. And I have to say today, after all these years of reflecting back, if I could go back to one place in St. Joseph's and virtually say, I'm going to buy up this room to celebrate, whatever my blessings, that would be Father Vase's sports room, where he had the hockey sticks, the shiny cricket bats, and those really lovely maroon and burgundy cricket balls, which I could not afford. So that would be my desire. There you go.
All righty. Well, how did that little kid from St. Joseph's, Bangalore, come to where you are today and lead us into? So Ash, we're all, I think, no matter how wealthy you are or if you are starting your career, we're all so worried about, first of all, if I'm starting my career, am I going to be able to do what my predecessors have done, build wealth, have a good retirement? Or if I'm through the other side where I've saved and worked hard all my life to come to where I am, and here comes this once in 100 years pandemic. Is it going to destroy everything? Should I be sort of running for a monastery to lock myself up for the rest of my life? What's happening in this world, Ash? And what are we guys supposed to do? Having done well and now seeing it all going, or starting with no hope ahead? Maybe you can start telling us something that all of us are dying to hear.
Let's start with this. There's an old saying, garbage in, garbage out. So in other words, if you have the foundation of the schooling that we all were so blessed to have, you literally have to just look around at the consistency of the success that's come out of that fidet labore cult that we were raised in, the faith and toil, the work ethic, the perspiration and the sincerity that came into our training. So my sense is, yes, that schooling foundation is a remarkable catalyst, which led to even further schooling and higher advanced colleges that we all been to. So academically, we came to this country much better prepared than most immigrants do. So that was one in our favor. First of all, would you agree with that, Jimmy?
Absolutely, and especially once I see your brother coming on screen to tell me you better agree with him, I say, yeah, sure, Dave. Absolutely. And I'll add one more thing. I'll add one more thing to what you said, Ash.
And my brother Suresh have both Josephites, and they were a tough act to follow. In fact, in many ways, I did not really have peer pressure as much as I had sibling pressure in my development over the years. So I would attribute the second aspect to my struggles and therefore eventual success to my brothers, both of them being here. So God bless them and welcome them. Three, this has now become intrinsic to my own coda and my own sense of being in America, and I speak to my American audience specifically at this, and that is never, ever bet against America. Beyond the land of milk and honey, beyond the land of dreams, aspirations, it is a canvas for talented and well-groomed people like us, despite the hardships, despite the speed bumps, despite the struggles, even despite COVID, to come out of it triumphantly. And I genuinely believe that. So I hope that answered some of your concerns about a young, or even someone beginning their careers in America. I'm so confident that they are well equipped and they have the right deck of cards that they've been dealt with to take on this country and its future. So,
terrific. So let's jump into what would you typically be sharing with your clientele, with the world at large? Because when Ash speaks, the world listens. When the former chief investment officer of Merril, Lynch, has something to say, maybe you get about as much attention as the chairman of the Federal Reserve today. So come on, let's hear from this humble guy from Bangalore.
Let me start with an opening statement, Jimmy, if you will. One, keep it simple, keep it uncomplicated. There is complexity in the economy and there's complexity in the markets and how you navigate both, but never confuse complexity with complicated. So if you can master the complexity, understand it, and from understanding it, translate the complexity into simplicity, then you have in fact done a lot better understanding the economy and the markets. That's my point number one. Point number two, the economy is not the markets, Jimmy. It's misunderstood. The markets are not the economy, not all the time.
Absolutely, yep.
Yes, they converge in the beginning when there is a crisis. They both go down together. But very soon, the markets are intrinsically chronic optimists. They look for reasons to recover and repair. So in this case, when COVID occurred at the peak of February, going into March, clearly, all bets were off, right? So it looked dismal, it looked terrible, and there was pessimism lurking in every corner of our brains. However, markets also suffered and suffered considerably. There was a meltdown, but the markets began to anticipate recovery, anticipate flattening of the disease curve, the viral curve, flattening of hospitalization, flattening of delivery, flattening of even slight microeconomic green shoots that are showing up. So the markets are like airplanes, Jimmy. They want to fly. It takes a lot for them to be grounded, and they'll always find a reason to fly back again. That's my point number two. Point number three, the trend is your friend. You snooze, you lose. And what I mean by that is don't overguess. Don't be so consumed with analysis because that'll cause paralysis in your interpretation.
Very famous, words.
Remember, the economy is far more predictable. The economy is far more a sizable block of facts, but the markets are 30% facts and 70% emotion. So if you
so what happens to this thing called the efficient market hypothesis?
Therein it itself is the idiosyncrasy of markets. So point being, if the trend is your friend, maintain that momentum. Don't overguess it. There are lots of people who are overguessing the fact that the markets have shot up, but the economy is plummeting. Yes, in fact, it is. That's because the economy is not the markets, and the markets are not the economy. Next, and probably the most final opening statement, never ever fight the Fed. Never ever fight the Fed. I've learned this. I've made mistakes trying to fight the Fed in the past or second guess them. But I've learned today that despite the optics of a government, the entity of government to us, Jimmy, is one that's inefficient, red tape, bureaucracy, lazy, lethargic, uninitiated. However, there are gems even within the government, the Treasury and the Fed. And only because the Treasury and the Fed is a magnet to some of the best minds and talents on the land. So garbage in, garbage out. So the decisions that the Fed makes and what the Fed made this time around in April was remarkable. Fast, adroit, proactive, large, to the point of being excessive, but that's helped the markets of the economy.
So Ash, yeah, that's a fantastic opening salvo here. And so already just listening to your first few statements, what I'm hearing from you is so much of what we were taught when we were young. And if I were to say in my own life, that's what's made me whatever little success I've been able to achieve. And that is keep it simple, take complex items, take out all the noise, throw away the garbage, keep the recycled part separately, reuse it. And one last thing before we move to the next statement is you talked about, the Josephite Foundation and things like that. And I've always shared with people who I've mentored in life that, there are so many different asset classes. There are stocks, there's bonds, real estate, jewelry, you name it. And every one of those have history behind them. Some of them are new instruments of few years. Some of them are instruments that go back hundreds of years. There's only one asset, Ash, and I'd love, at some point for you to address this. And for all the Josephites out there, young and old, there are assets where you start the year at 1,000 or 1,000,000 or whatever that number is, 100, and you can double it, triple it, quadruple it, or you could lose 10, 20, 30, 50%. There's only one asset that starts every year at 0 and ends with a number higher than 0. There's only one asset in the world, and that's you.
True.
So take care of that asset, keep the health of that asset, monitor it, improve it, and I can sense from you that that's the type of person you are. Trust yourself. I'm hearing all this and seeing this on this video. Bad news, more bad news. But what does Ash have to think about, his asset, which is, his brain power, his years of experience, etc. What's the next slide going to tell us?
There you are, which is a nice segue to my macroeconomic observation, if you'd allow me to share that with the audience. And this is what I did. And Giri, if you'd like to move on to the next slide, that gives me the concept. And I'll come back to this visual right after I finish. If you can just progress to the next one. The reason I bring this up is, in talking with Thomas, and Thomas had a fabulous idea. He said, look, Ash, one is to have your opinion, which I do. And I have the luxury of having one, except my luxury ends at having an opinion. I have to translate that opinion into actually running money for my clients. But he said the audience will, the Josephites will really benefit, not just from your view, but from a consensus view, so that they have access to a spectrum of possibilities in their views and form their own view when they walk away from the session. I concurred, and this is why I developed this consensus view versus my view. I say versus, tongue-in-cheek, but I'll come to that. If you can look at the consensus view, and I'll summarize this for you. And by the way, if you're anticipating me going through every point in a slide, you're going to be disappointed. As a career as a public speaker, I never hugged my podium nor my PowerPoint deck. So I'm going to summarize, if you will, Jimmy, if that's okay.
That's fine.
The consensus view is this. We are now looking at a 17 to 20% unemployment rate by July, if not by August. We are looking at possibly 35 to 45% compression in earnings in the second quarter and third quarter. So let me stop there and ask you this. Do you want the bad news first, or do you want the bad news next, right? and I can almost, as a chronic optimist, I feel almost poisoned, but having to share these facts, but these facts are dire. So unemployment at 20, 35 to 40% compression in corporate earnings, 3 to 4 trillions of an added deficit to an already climbing deficit that someday will pay back some way or the other, if not in inflation in the next 2 or 3 years, but down the road to our children and to the next generation in terms of taxations and so on. But most important part, striking part of the consensus view is this, and I have to agree with that, is for the first time ever, we're witnessing a steep and deep recession, much more severe than the 1930s depression. So that in itself is
Wow.
enormous in scale. So there you go. That's the bad news. Now, further worsening that news is the dispersion that the economy has demonstrated, which means it has developed a set of winners and unfortunately a set of losers. The losers are the obvious suspects in the economy. These are airlines, cruise lines, recreational sectors and industries, leisure, restaurants, brick and mortar retail, anything that involves people, anything that's a victim to social distancing has suffered in the economy, and it'll probably take 2, maybe even 2.5, 3 years to recover. But on the flip side, something very unusually positive occurred in that those industries related to staying at home flourished. Streaming, as in Netflix and Amazon, online e-commerce retail, so you don't have to go to a brick and mortar store. Again, Amazon, Target, Walmart have flourished. Yoga pants, who would have thought, has just bloomed only because more people are staying at home and they're pursuing athletic and physical recreational activities. E-commerce and e-commerce enablers like the Shopify and the Twillions are now enabling small businesses and medium businesses to be digitized because of the fear of people not showing up at the brick and mortar stores have flourished. And the list goes on in that, why even Zoom, on which we are today, because we're now distance operating or remote managing, has mushroomed these businesses up. So there's a dispersion in the economy. That's the consensus view.
Yeah.
Are you ready now for my view? Go ahead.
Okay. Yeah, that's really a nice way of putting it. Now, as we start looking towards this, it's almost like a reallocation of a portfolio, because what you're saying is, I had a certain portfolio. Certain parts of those portfolio are not performing or not likely to perform, whether it's the cruise line business, the hotels, travel, etc. So I've got to get out of those, get into something that is, and now the portfolio is rebalanced, looking the next 3, 5, 10, 15 years, right? So love to hear now what the optimistic side is. Obviously, there's so much of opportunity here, and you've named it. So how would you start advising people? Let's, if you don't mind, Ash, we've got a wide audience here. Let's try and talk about what would someone do in their, let's say, the early part of their career. You know, they're building, they've just begun their life. Someone like Giri, for example, just got married in December. Let's take an old fart like Chandra Mohan. I had to get that out, Chandra. But anyway, let's take guys like us, you know, in our 60s. We're kind of looking at a time where we're phasing out and hoping to retire comfortably. And let's take people in between. They're doing extremely well. They're in their early 40s and things. How do we start guiding these people to look at that future? For example, if I look at myself, I'm hoping to retire in a couple of years. Should I be dramatically changing my asset allocation portfolio? So for example, if I was in an 80-20, 80% stock and then 20% others, fixed income and others, should I be switching it dramatically? Even within that stock portfolio, whether it's 80%, 60%, 70%, should I be dramatically changing the mix of those stocks? So not everyone has a financial background. We've got tremendously talented Josephites then in all functional areas. What would your advice to them be, you know, as we begin to move post-COVID?
So if I were to rephrase the many prongs in that question, Ginny, it would be this. One, if you believe that asset allocation is a necessary mandate and foundation to any kind of portfolio formation, then I will offer my prescription or my views on how to develop that for different age segments and persuasions of Josephites on this call. That's one. But two, in order for me to do that, Jimmy, I have to preamble that with a basis and a foundation view of the economy. But having said that, having said that the economy is not always necessarily the markets and vice versa, the state of the economy and the psychology of the economy does shape the level of risk, the level of liquidity, and the level of diversification that's going to be impacted in the asset allocation. So if you will, let me spend 2 more minutes on just contrasting my view of the macroeconomy versus the peer views or the consensus views I just shared. May I do that first?
Yes, please do
And
that.
then I'll go into the asset allocation prescription. So if I were to go back,
Just go back one slide, maybe.
Giri, and if you can make that, can collapse that as an entire page so you could see the My View section a little clearly, which means we have to lose Jimmy for a moment, and even me.
I think that's on your side, Ash. Most of us can see the whole slide.
Oh, they can see. Oh,
Yes,
fabulous.
yes, yeah.
I thought they're trapped just in the windows. Okay, so this is my view. My view in many ways migrates from the peer views and the street consensus. But after, again, a disclaimer first. Remember, I'm a chronic optimist. In my view of things the last 33 years that as a practitioner and as an academic, for me, there is no half a glass empty, Jimmy. It's always a 3/4 or a full glass full, if not 2 glasses full. And they're not regular sized glasses, they're Patiala glasses. So you have to filter that into my view. My view is this. Yes, I agree with my peers. It's going to be a miserable second quarter. It's going to be a miserable third quarter. But I am eager, and I believe we'll see green shoots of recovery in the fourth quarter, which means all of the pent up demand, all of the pent up productivity within corporate America, all of the pent up efficiencies that were already in place. Remember, we were becoming a digitized economy, a digitized corporate America, even before COVID hit us. COVID was a catalyst to accelerate our infusion of digitization into just about every business in America. We're going to come back, I believe, with a vengeance in the fourth quarter. So that's going to translate into the 35 and 40% erosion of earnings to a comeback in earnings power, with that comeback in earnings multiple or multiples or valuation of the market. And as a result, I'm willing to stick my neck out today and call for the re-emergence of a new bull market in 2021, which is next.
As early as 2021, you think, huh?
True, but starting in the fourth quarter. I think we'll set up for a fabulous year in 2021 in the fourth quarter after suffering the tumult in the second and third. How does a bull market of 11 years die? That's a question you have to ask. Bull markets don't die with one punch. No, they don't. You need a left hook, a right hook, and a body slam, much like a Muhammad Ali matrix into a knockdown before bull markets die. And that's what happened in March. But the recovery of a bull market is what you see is going on now. Dead cat bounces in the market. Almost feels like optimism has come back and recovery's come back. But not to be completely misunderstood, there's a possibility of another retest of the March 23rd lows. In our business, we call that a retest. It could be 5%, 10, 15, who knows, and when. But when that happens, when that second level of capitulation happens, a feeling of blood in the streets, that's when you set up for the birth of a new bull. That's what I'm calling in this very call.
Wonderful analogy. Yeah, that's terrific.
Now, that doesn't mean that when we do have a bull market, all sectors will flourish. So the rising water will not lift all boats. Like you said in your narrative, there will be winners and there will be losers. So sector allocation is equally important to asset allocation. So now let's address the asset allocation part of your question. So Giri, if you could go to exhibit number 8 and 9, that'll help us set up the asset allocation charts. I think, again, Jimmy, I want you to be my time governor.
Yep, we're about halfway through, but let's get to some of the questions as soon as possible, okay? So let's go through one more slide, and then I've got a couple of questions that we'll get into, if you don't mind.
I'm addressing the asset allocation question. Can I?
Yes, go ahead, please.
There you are. This, by the way, Jerry, comes from your friend Markowitz, the efficient frontier theory. So I stole his basis, but expanded on it to define my development of an asset allocation prescription. So what is it? An asset allocation can be done two ways. You can just shoot from the hip and just use the age of the investor as your fixed income allocation, the remaining being in stocks, which means if you're 40% in bonds, 60% in stocks. If you're 70 years old, 70% in bonds, 30% in stocks. I don't agree or believe.
Nor would I. Because otherwise I need to be 63% in bonds and I'd be dying.
Right? Instead, I arrive at asset allocation from a slightly more complex angle. I look at, and you should, each one of you in this call should look at your age, your risk appetite, your risk tolerance, two different things. Appetite for risk is different from the threshold of risk, two different metrics. Your liquidity constraints, how much money do you need now as cash flow and how much you can postpone. The more illiquid, higher the returns, more liquid, less the returns. More risk, higher the returns, lower the risk, lower the returns. So age, risk, liquidity together form an asset allocation discipline. Add to that your view of your world, your job security, your wealth effect, which means your real estate is doing well, your investments are doing well, you have remarkable job enhancement, your children are flourishing in college. All of this contributes to the wealth effect, which once again shapes your asset allocation. Furthermore, what you do for a living, if you're a businessman and a successful businesswoman, the fact that you're an entrepreneur may accentuate your biases towards stocks versus bonds, and therefore that may shape asset allocation. So someone like me as a practitioner and an academic, I factor in all of this in this very chart. The left axis, as you go up, shows higher return. The bottom axis, as you go further out, shows higher risk. So if I pick an asset allocation consisting of, say, real estate, hedge funds, private equity, which means these are all high risk, high reward elements, I'm going to go further down the risk scale on the bottom axis and high up on the return scale, the return axis. So sum total, the combination of those very aggressive, exotic investments or asset allocation would be somewhere to the northwest of that screen, of that chart. So if you were to picture the chart to be the chart of North America, high risk, high return is going to be where Maine, the state of Maine is. Low risk, low return, high risk, very low return is going to be the state of Florida. Very high risk, but also comparable record. So you can make out positions in the map based on the combination of risk and reward. So for me to arrive at an optimal asset allocation, I look at that red line which Markowitz invented. We call that the efficient frontier line. Mm-hmm. He declared, and I concur, that on that line lives the most efficient combinations of stocks, bonds, real estate, hedge funds, private equity, currency, commodities, as the case may be, and the prescription on any dimension of risk. The higher you go on the red line, you're taking on more risk, the lower low risk, but at that line is the optimal combination of risk and reward.
So Ash, let me add something. The great man is not here, obviously, but he's here. In the last time I met with him, we have a quarterly luncheon together. He shared something with me, which not only like your opinion, but also to share with everyone else. He said, when you look at portfolio theory, which is what he invented with his Nobel Prize-winning thesis. What he says is the dimension that's not on the risk return is time. And when you look at time, and that pretty much is your investment horizon, today with instruments like trusts and things like that, where we create these, revocable, irrevocable trust for a family, you're now looking at generational investment. So don't look at your age. Look at the age of the portfolio. And if your portfolio is going to more or less move to your children. Now, if you're planning to spend out your money before you die, so be it. There's a different strategy. But if your strategy is to live a healthy life, enjoy your evening of your life, and then transfer your wealth, which is what I hope you will address, the asset lifetime is multi-year, multi-generational. Therefore, you have to act as though you're a 30, 35, 40-year-old with 50 years to go. And don't start getting into this panic that I'm 80 years old, I've got to be 80% in bonds. I thought that was really common sense, but that's why geniuses like him have so much of common sense. So why don't we address this? Because I think you've covered Thomas Tekatella's first question, which is, the grand old sage of Omaha, Warren Buffett himself is saying, preserve cash, etc. And then the young maverick Josephite is saying, don't panic, guys. This is an opportunity. Just be wise in how you reselect and rebalance. There are some losers, there are some winners. So you've kind of addressed Thomas's question, but I know you got very quickly, if you don't mind, talk to us about these, building wealth, keeping wealth, transferring wealth, because I know you've got a few slides with that. If you could do that in the next 3 to 4 minutes, that will give everybody a pretty good feel, regardless of who you are, young or old, or retiring or not. Just give us a very quick overview of what is Ash thinking about in terms of building wealth, retaining wealth, transferring wealth.
You nailed the summary. So if I can ask Giri to go to slide number 12, that'll help me address this particular answer further. One more. Thank you. No, the previous one, please. Thank you. Can all the Josephites see the entire screen?
Well, I guess they're not going to respond, so I'll say yes, I can see it.
Outstanding. As you can see, there are 3 distinct pillars in this visual. Each pillar represents precisely what you just talked about. The preservation of wealth, the growth and distribution of wealth, and finally the transfer of wealth or legacy of your wealth to your children, charities, and philanthropies. But there's also another progression that's taking place in these 3 pillars that I put together. The very first pillar is your basic risk mitigation to preserve your lifestyle. What does that mean? You've got to live. You've got to endure life in order to be successful, in order to foster wealth generation. So in order to do that, you have to mitigate 3 or 4 risks that are going to confront you. Risk number 1, mortality. If you're a young couple and you have dependent children, and the 2 of you are the only income earners for your family, obviously your mortality matters. So preserve yourself with the appropriate solutions, be it life insurance, as the case may be. The second risk is longevity risk. What if you outlive your savings? Because our mortality tables today, living in America, has been extended. Is there a chance that all of your life savings could be exhausted before you pass away? Possible. So mitigate that. And there are some solutions to longevity risk. Catastrophic illness risk. No one has really recognized this until recently.
That's right.
Yes, there is Medicare. And yes, Medicare will support 65 to 70% of your health needs as you grow. But if you have a catastrophic illness, God forbid, Alzheimer's, Parkinson's, which has a lot of home nursing, home interventions, Medicare is not going to fund it. You need to have a resource that funds it. Long-term care insurance is a solution. Again, these are risks that you need to mitigate. I have a reserve risk there, which is redundant to this audience. Reserve risk essentially means, even if you have a top-notch job, but what if you get laid off? Do you have a 6-month reserve to support your family? And I'm sure the answer is a resounding yes, because culturally we're very conservative. We tend to be savers and so on. So we won't talk about that risk. But nevertheless,
so Ash,
number 1 is risk.
Yeah. So for the younger generation in our audience today, when you start talking about things like, elderly care and things like that, we always think of it as our parents or our grandparents. But as you grow older, you realize, holy smokes, I'm 20 years from that time, right? So would you be advising young people like Giridhar or Anaga or whatever to start thinking about something like, a healthcare plan or, a medical plan, insurance now, where the premiums would be relatively low? And, when they get to that 80, 85 or whatever it is, because, many of us don't think about that because we feel, we live on forever. And besides, this is more for our parents and grandparents, not for us. What would your take be on that?
Jimmy, you brought up a fallacy that's implicit in all of our thinking, which I'm glad you did. I'm going to cleanse it further. Yes, there are young Josephites in the audience, and to them, the notion of catastrophic illness, the notion of longevity risk, the notion of even retirement seems so distant, redundant, and almost irrelevant to them. Wrong.
Absolutely,
All
agree
I'm
with you.
trying to establish is to template the awareness of these financial wellness issues now. You don't have to act upon them, but template them as the pathways that you will encounter as you hit those age limits when they become a priority. So that's the reason we're doing this. So let's get to the middle one, which is very sanguine, very precise, and very, very pertinent to young and middle-aged couples who might be embedded in this audience. And that's wealth growth. Growing wealth, the accumulation of wealth and the preservation of wealth begins on the first day of your job, Jimmy, and lasts till age 60, 65. Till then, every day, all you're doing is becoming an income champion. What does that mean? You're progressing in your career, you're becoming the best you are, you're increasing your earnings capability, you're increasing your marketability, you're bringing home the money. That's all you're doing. You're accumulating wealth. But remember, income champions are not necessarily wealth champions. There are two pillars of success. So while you're being consumed as an income champion, you need a parallel track of building wealth simultaneously with the excess income and savings so that the day one of retirement, when income stops, wealth takes over.
Terrific. So Ash, what we've been doing, and for our audience, you may be wondering, hey, wait a minute, I've sent a few questions. I haven't got an answer yet. Well, actually, you have got quite a few answers. So if you don't mind, Ash, I'll kind of quickly, we'll do this on the really speed answering thing. You've already addressed Thomas Teketela's question about, Warren Buffett and preserving cash, etc. You've also addressed Divakar's question regarding, given the divergence between economic reality and the current US markets, is there inherent optimism? And I think you've said, you are the internal optimist. So I think we've checked off that. And the next question comes from Akila. And she says, what steps can young professionals take to either start investing or to build a financial portfolio in these times? I mean, right now you're wondering, should I keep all my cash because, will I even have a job tomorrow? And now someone else is saying, well, start investing when you're young. You can't start investing when you're 70 years old. So what do you tell a young person, how do they start?
On a bit of advice, a structured piece of advice for Akila. And again, I'm going to resort to my portfolio construction building blocks slide, which I believe is right after this, Giri. If you can just proceed. Oh, that's the one. Thank you. Thank you. Here we go. So Akila, two portfolio building techniques have helped me in my career. There are several, by the way, but two particularly have come to help me. But even before I embark on that, not just to answer your question, but also to provide best practices to the entire audience about wealth building, here's my advice. Today, there's a decent chance that the investments that you own comprises of a list of attractive choices, a list of attractive stocks and bonds. Throw that list. A list is not a portfolio.
That is correct.
A portfolio, on the other hand, is a living, breathing, entwined alchemy of facts, economics, overtures, animal spirits, stocks, bonds, anything in between, real estate, as the case may be. It's a confluence of risks, liquidities, durations, like Jimmy mentioned. So a portfolio has a lot more moving parts than a list. A list is decent. It's a good start, but convert that list. Give that list a life of a portfolio. That's point number one. But how do you build that portfolio? One technique is called core and satellite. And Akila, you can do this either yourself or with an advisor or a planner who assists you, but make her or him accountable to follow this discipline. It's called core and satellite. The core consists of a diversified bed of benchmark ETFs or index funds, low-cost rendition of replicating the markets. In other words, an S&P ETF, a NASDAQ ETF, international ETF, if you're gung-ho about MSCI in the world, that's your core, that's your bed, that's your bedrock. Once you have the core and you've gotten the diversification done, because remember, ETFs are plural baskets and clusters. You're already well diversified. Now you can have satellites, which are long shots. These are individual stocks where you have high convictions in. This could be a company that you work for that's public or about to become public if you're a venture capitalist in it or your private equity exposure in it. These are public companies that are assertive in the technology space, in the cloud space, in the e-commerce enabler space, perhaps, or biotechnology, perhaps the invention of the next vaccine or testing for the virus. So those long shots are high risk and high reward. Remember the chart from the past? High reward, high risk is going to be right up there in Maine. You want to bring that and balance it with your core of boring, predictable ETFs, which are in the lower spectrum to the left. So sum total of these two brings them to a nice optimal center on that frontier line.
That's really a neat way of putting it. And I think if I could summarize before we get on to the next question, the younger the people, and I'll be honest, I did that early in my life as well. The tendency is you feel you've got a hot tip, let's go with it. But what I've heard you saying, it's so beautiful, is build that bedrock. There will be time later in life where money can make money for you. And what you've said, Ash, which I think it should resonate, especially with the younger ones, is build that bedrock of a solid portfolio that will get through the ups and downs, and where we don't need to get into beta and things like that, but where the variation is moderated by the markets, by your portfolio. Once you've got that bedrock, then you can start what we call the play money, the money you can put at risk and go heavily to the right-hand side of your chart. Fantastic. Well, let's see. We're already taking on the next question, which is the uncertainty. And Naveen Potan has a quick question, which I think you've answered. In fact, you've answered most of these questions. In this uncharted time of uncertainty, instability, fear, what sources of financial advice should a young investor lean on? And I think you just answered it, right? Which is build the bedrock. Don't take your eyes off that. Let a professional, in fact, the very fact that the ETF by definition is a professionally managed group of, you don't have to pick winners and losers. You can just broaden if you wanted to get a little bit more of portfolio, let's say risk mitigation, you just go for a broader index. If you're not too comfortable with one, you can go for a broader index. So you've answered that pretty well. Let's move to the next one. Francis has a question talking about mortgage rates. We've talked so much about the markets, but many of the people today are young people. They're buying homes or wanting to buy homes, like many of us had an opportunity years ago. Considering that mortgage rates are dropping, and there's a thought of even negative interest rates. Let's consider that. Is it a good time to buy or get either investment property for rentals or buy your own home? And are there better ways to leverage your investment considering the 10, 15-year horizon? We haven't addressed that so far. So what would your thoughts be? And before we go any further, like a true Josephite and being a bully, because I'm older than you, I'm going to ask if it's okay to continue this beyond the 9:30 mark, because, hey, if Rahul Dravid could give us extra time, surely Ash would, right?
I'm happy to do that. It
Thank
depends
you.
on the audience. If they can survive the bald and the fat combination, we are good. We're good to go.
But let's get back to this. Well, so first of all, everybody on the phone right now, we will be extending this. There's thanks to Ash, we will take. And if you have some more questions, please go ahead and send it in. Aga will be feeding me more questions. But let's take this one from Francis about real estate, about mortgage rates. What thoughts do you have on that, Ash?
Yes. So my advice to Francis is this. I think culturally, coming from India, we are intrinsically well equipped to understand real estate because our grandparents and parents did remarkable jobs owning real estate in India, perhaps even here. So we have an affinity for real estate. We understand its risks. We are patient about the duration quotient of real estate, which takes time to harvest. We understand that there are peaks and booms in real estate, and we are ready to harvest at the peak and make a profit. We also understand that real estate is not just a capital gains asset, it's also an income producing asset. So it could provide a remarkable cash flow during retirement. The cash flow is king and not so much the wealth that's implicit in retirement. So for many reasons, we already are way ahead of the curve as real estate investors. But that being said, for Francis, you need to position in your overall asset allocation matrix where real estate holds itself as an asset class. So if you've arrived at that 70% equities, 20% bonds, and you have 10% of shopping left, and in that 10% of your overall net worth is what needs to be attributed towards real estate in order for the overall portfolio, your household portfolio, to gel. So it's easy for us to get carried over with an asset concentration because we're good at it, and that's okay too. But if you need a balanced, diversified, but at the same time, progressive portfolio, especially with real estate, or for that matter, art or other exotic assets, allocate them first and then execute them either by buying it for capital gains or buying it for income or both. So yes, rates are low. You won't go wrong if time is in your side, if you give it 3 years, 4 years, 5 years for real estate to flourish. And if you nail the proper demographics of the location.
Absolutely, yeah. That's what I was about to say.
Real estate aspects, you're good to go. The answer is you're good to go.
Terrific. Let's move on to a couple of questions from Gautam. So Gautam Ijur says, given the unprecedented nature of the pandemic and the resulting recession, will the effects expand beyond the likely industries like retail, etc.? And could that start moving into what we consider the bastions of any economy like banking and, let's say construction and things like that? Do you think, should we brace ourselves for another sort of depression, or do you think that we've pretty much taken the biggest blow? There could be that testing of the waters again, a little lower. But what's your opinion, Ash, on this?
So I'll take the latter part of the question first. Are we tracking a depression era like melancholy in the trend line in this market, in this economy? And my answer is an emphatic no. But then again, my credibility is at risk because I've declared that I'm a chronic optimist. Okay, 1. 2, coming back to the sectors that have suffered because of COVID, we already have a working playbook, if you will, Jimmy, that we did not have on February 2nd week or even in March, but we now have in May heading into June, what sectors worked and what sectors did not work. And there were surprises in both. What was not a surprise is that airlines hurt, cruise lines hurt, luxury retailers markets hurt, brick and mortar retail where people could not go to hurt, restaurants hurt, recreation hurt. We got that. But on the flip side, we were pleasantly surprised that there were benefactors of this new normal. We stayed at home, we Zoomed more socially and on business. Zoom and other video conferencing enablers did well. Any kind of business that was thinking of the future and saying, geez, we have lost our clientele. It's going to be a while before the clientele comes back. And even if they come back, it's going to be very selective consumption. So we need to get our act together. If they don't come to us, we can bring it to them. So they use the Amazon model now in just about every business. So if you're a Shopify or a Twilio or an Okta, and you're enabling these businesses to become digitized, you did well. So yes, there's going to be a separation. The separation is going to continue. Healthcare could be the new champion sector only because not only will be there 15 pathways to developing a vaccine and another 12 pathways for developing a test, but there could be other diseases, other compounds, other maladies that can bring forth the whole biotechnology empire, if you will, and that could be an opportunity as well.
Terrific.
So my advice is, yes, it seems dire. It gets worse before it gets better. Second and third quarter, just bite the skin of your teeth and resist and hold on. Take on the next hit. It could be 5, 10, 15% in the market, as the case may be, but hold on. It's going to feel like you're inside a shark cage with sharks whacking you from all directions. But never bet against America. Never fight the Fed. The trend is your friend. And if
Terrific. I love the way you put all these things together, Ash. And Gautam has one more question that may kind of take us into the political side, and I'm going to advise you, let's not walk into that trap, but still of being very pragmatic. Gautam's questions, more a statement. He says several studies have shown that government intervention, getting money directly to taxpayers, indirectly through small business, etc., sounds great, fantastic. Let's give away trillions more dollars. Gautam very wisely asks, are there limits to government action, and how far can we go? Will this land up boomeranging and affecting our children or the next generation? So again, without getting too political here, let's try and address Gautam's question here.
I think Gautam's concern is fair, legitimate. His forecast of a negative boomerang is again valid. There's a however to my answer. The however is, often it is the optics of an overture that carry more weight to influence stock markets. Now remember, the economy is a far more, I'm from Missouri, show me like entity. The economy does not get moved by optics. The economy gets moved by earnings, incomes, GDP, employment, and other hardcore variables. The markets, on the other hand, is far more easily convinced about optics. So when the optics of the Federal Reserve coming right out there with shock and awe, Jimmy, 2 rate cuts, QE to the hilt, to the point.
And let's make sure everyone understands that's quantitative easing, right?
Quantitative easing, putting liquidity to the markets, and then backstopping banks from collapsing, and even better, instigating and being a catalyst for an otherwise lazy, lethargic Congress, a very divided Congress, to come in with a bipartisan relief of $2 to $3 trillion with another tranche that is up for debate. The optics alone is dramatic. So to the point about the actual small business loans helping the economy, or the actual $1,200 checks that went to individuals making an impact, the jury is out on that, and we won't know its effect for many years. But what is instantly filtered into the optimism and the repair of the markets are the optics of those overtures. And yes, there could be higher inflation down the road, there could be higher taxes for our children down the road, and there could be a risk to Social Security and other programs down the road.
That's very well put. Let's move on to Giri's question. Giri says, Ash, what are your recommendations for individuals considering investing in emerging markets like India? And are they less attractive now than they were before because of their ability to transition to this new normal, which even I haven't figured out what is this new normal? What would your response to someone like Giri be? He's a very, some of us, I'm not sure all of us, but some of us have really benefited from a rising market in India. Whenever I meet with my personal advisor out in the United States, and he shows me that my average over the last 5 and 10 years has been 6.8 or 7.5 or whatever that number is, I take out my investment portfolio in India and say, look, I've had the same portfolio in India for 17 years, and my XIRR on that is at that time was about 17% average through the ups and downs. So how do you tell someone like Giri, who is keen on investing, quote unquote, back home? Would those markets be, has the world changed now where China and India and all that is going to be less than what we anticipated, because we are now moving from that so-called globalization back to localization? Your thoughts?
Emerging markets are exactly that when they are flourishing. When they're not flourishing, I have to admit, they are submerging markets.
Interesting. Interesting.
And I don't mean to be tongue-in-cheek when I say that. I mean that sincerely. 3 years, 4 years ago, if you asked what my sector allocation or asset class allocation was, yes, I had a sampling of emerging markets in my country exposure and a sampling of developed Europe in my country exposure. Today, the only game in town is the US. The only recovery in town is the US. So I'm very parochial and partial to the US in my country allocation. That does not mean that the emerging markets does not have the veracity and the muscle and the potential to flourish, as you indicated in your India portfolio. But then you are an unusual India investor in that you did not mess with the buy and hold strategy.
That's right, yes.
Yeah, you probably bought blue chips.
Absolutely, top of the line, yes.
Bought and hold and stared at the paint becoming dry. And it worked for you. It does not necessarily work for other reasons. When US dollar is strong, emerging markets suffer. When global money allocation is pointing towards Western Europe and the US because rates are low, emerging markets suffer. Emerging markets suffer when there's regime, political and destability risk in the regimes of those markets. Emerging markets suffers when their GDP to debt ratio is declining. They suffer when they have currency issues. So the net negatives versus the net positives are not in favor of EM today. That does not mean if you have boots on the ground in India, which is your home country, or if you're Chinese, if you have boots on the ground in China, not to have a little footprint there. Because one, you understand the risks, you understand the local dynamics, you may even have a relative or a friend who actively runs it or manages it. In that case, yes. But otherwise, for the time being means for the next 6 months, I am agnostic and therefore want to stay with the US and not EM.
Terrific, and I appreciate that. You know, I'm adding a little bit to Giri's question here, and that is in terms of timing. I think I fully agree with you, especially for younger people today. I think I benefited because it was 18 years ago, where India was literally rising, and now the markets have stabilized now, and you're not seeing those runaway fantastic returns. But talk a little bit about COVID. I mean, the impact of COVID, the impact of the China syndrome now, this sort of anti-China sentiment. And I'm not talking about the political noise that comes out of Washington. I'm talking about people on the street getting a little upset, whether it's from Australia to Belgium to Germany to Italy. You know, it's not out of Washington. There's a general feeling that China let us down on this. And as a result, already, I mean, you see companies like Apple saying, we're moving $40 billion of new investment into India. Would that, now we're talking only India, not all emerging countries. Do you think that this sort of backlash will a positive impact, at least in the short term, for an investment in India because of this opportunity provided by this anti-China sentiment?
Embedded in your narrative, Jimmy, is a country or a region shift in the supply chain.
Yeah, that's what I see. That's what I do for a living. Yeah.
Which is very dear to you because that's your core practice.
Yes.
But you know and recognize that supply chain shifts were happening out of China even before.
Absolutely. Yeah. We called it reshoring, and that started a few years ago.
Okay. And the immediate benefactors were Vietnam, Indonesia, Laos,
Thailand, Cambodia, all that area, yes.
As the case may be. Now, because of the reacceleration of China, not only as a higher relative cost in the Asian band player, but also the optics of being tainted with this whole COVID syndrome as a bad player that might aggravate that supply chain movements out. Now, India is usually the quickest recipient of such a supply chain shift, but we have to understand this as well. India is outstandingly talented in its supply chain infrastructure and its ability in some specific industries. But at the same breath, India executes poorly, and there's execution risk in certain other industries where mega quality control issues become the deciding factor of any kind of merchandise and trading. India has not reestablished itself consistently as a high supplier of quality. But having said that, do you allocate to India in your emerging markets portfolio? Sure, but what percentage, how much, and what should your attitude towards that investment be depends on each individual investor.
Terrific. Now, this was the last question, but I'm going to ask if you don't mind, we're about 10 minutes above. But if you don't mind, there are 3 or 4 that have come in literally in the last few minutes. But let's go to Krishna. Krishna Khan says, to those individuals who plan to return to India after working in the United States, what advice would you give them on handling their 401k? Should they keep it here? Should they pay the penalty, close it out, invest it in India? What would you say?
Okay, but my answer is going to go beyond the 401k structure.
Your entire portfolio, yeah.
Become the prodigal son to go back to India. That's outstanding and remarkable to revisit your home country. But never ever confuse patriotism and a sense of being in your home country with the realities and pragmatics of global commerce. It's like pulling teeth to get assets transferred from India to the US. Why would you therefore consider transferring assets that you have so painfully earned and struggled to have earned, it's just sacred wealth in the US, and deploy it back to India? So to me, there's an intuitive non-starter in that movement. But
I agree with you on that. Yeah,
bias that I have against any emerging market country, leave alone India, where I want my American-earned assets staying in America. Because one, it's easily accessible, the governance is more trustworthy, the ability to transfer out to the US is much easier than transferring in, and taxation rules are becoming more complicated as we go on. So for all those reasons, if you can generate an independent cash flow and a source of income in your home country, maybe slice out a little from your 401k here, but not the entire wealth that you earned in America.
Very well said. That's great, Ash. Now let's go to a couple of people who've put in their questions. Vernon D'Souza asks, what if there is a vaccine and widespread distribution of this vaccine by, say, the early part of 2021? How quickly do you think the markets will react and go back to the sort of the pre-COVID or February 2020 levels? How fast do you think markets adjust, or do you think the markets are already adjusting for that?
Yes, I think you answered the question there, Jimmy. I'm sure there are several healthcare professionals in the audience, those who are deeply involved in biomedics and biosciences. We have shortlisted globally 16 vaccine pathways, 2 of them extremely credible and almost current. One is from Moderna, and the other one is from Pfizer, that is in development in clinical trials number 2 with a fast track from the Food and Drug Administration. The remaining 14 are catching up. In fact, the Oxford work on vaccine, with India being a partner on the scaling aspects of the vaccine, is also promising. So the markets have factored in that optimism already. In fact, the markets are set up to believe that we'll have at least vaccine for healthcare workers and
probably the elderly as well, yes.
By year end. And if it does not happen, we could see a disappointment in the markets. Now, next year, 2 things have to occur. In fact, 3 things have to occur. There needs to be a legitimate vaccine that's passed animal trials, human trials, placebo trials, control versus placebo, and that is actually ready for approval. But they also need to ensure that they have scaling manufacturing capability to create a mass explosion of vaccine availability. 2. 3, simultaneous is testing infrastructure. Today, we just have Abbott that does one level of testing and Roche, and perhaps one more. But if we can get testing consistently, reliably, then that's going to increase the confidence for people to re-enter the orbit of corporate America, industrial America, business America. So.
Terrific. And here's the last question before we start wrapping up from Kaustubh Raghavan. What are your thoughts on introducing metals like gold and others into your portfolio, given quantitative easing? I'm not sure how it relates, but basically we haven't really talked. We talked of real estate, we talked of stocks, bonds, etc. What about the other asset classes like commodities?
Fair enough. This is a reflection of how sophisticated this Josephite audience is. I don't ever get questions on managed futures, commodities, precious metals, industrial metals. I'm very refreshed in that I'm hearing this question. I have a regimen for precious metals and industrial metals. Gold is noted as a flight to quality or a flight to safety. When bad things happen in the global economy, gold is usually the recipient of that cash movement. So is the US dollar and the Swiss franc. These three are called flights of safety and flights of quality. One being a precious metal, gold, and the other being currency. However, I need to make an allocation case within my asset allocation for precious metals and industrial metals, and I'm not ready to do it. However, when the animal spirits come back into the economy, we are pumping a 3-handle GDP, wherever that is. We're pumping a 3.5% unemployment rate, wherever that is. And we come back to a 20 to 25% escalation in earnings, and everybody's wealth effect is macho, then I might consider copper, I might consider palladium, and palladium is usually correlated to the increase in vehicular sales, Ford, GM, etc. But I'm not ready to do either gold or industrial metals as we speak, personally in my allocation.
Well, what a golden way to close this up. Ash, I want to say thank you so much. And we could go on and on and on. And maybe we'll have you back again sometime. But I really appreciate it. It's such a wonderful way I'm going to make you feel bad about this. I really do mean it. It was listening to someone like Mr. Alvarez or Mr. Yates or one of our great teachers. And I think St. Joseph's could use you to go back and be a teacher for a little while, but you've taught us so much, and your way of teaching, this absolute simplicity of it was fantastic. I really appreciate it on behalf of everyone else. I'm going to turn this over back to Thomas now for some closing remarks. So once again, thank you, everyone. And please, everyone, don't hang up right now. We've still got a couple of closing remarks. And most of all, I want you to stand by for the school song. So stay tuned. Thomas, over to you, sir.
Thank you, Ash and Jimmy. That was really great. Just wanted to announce the next speaker session will be in 2 weeks, Saturday, June 6th, same time, 11:30 a.m. Eastern, 8:30 Pacific. The speaker session is being coordinated by the Josephite girls. The topic will be social entrepreneurship. We're going to have 2 amazing speakers, Pratna Ramesh and Sapna Karim. They're part of an organization called Jannah, which is doing some amazing work in India. So that is on deck for 2 weeks from now, Saturday, June 6th. They'd be connecting in from India, where they're doing all this work, which I look forward to. Again, in summary, we have 3 programs that are going on right now at Jonah. The first is the speaker series, of which this is a part. The second, the mentor program. The third is the entrepreneurship program. So if there's anyone among you who would like to volunteer to help lead, advise, participate, please get in touch via hashtag #JannahVolunteer on LinkedIn. So I turn it back to the working committee, etc., to set the tone for the school song. It'll take them all to replicate Father Furtado's initial note. So I hope you can all join in. Here we go.
Okay, who's starting it?
Giri, you're going to bring up the.
Yeah, he's
you're
got
going to bring up there. Yeah.
Okay, boys, let's go. Ring out the battle call of duty, unfurl the flag of faith and toil. We deem our souls eternal beauty, a lifelong victor's worthy spoil. 1,000 are proudly gone before us to win and spread our school's renown. 'Tis our to swell with our voices of chorus and with our deeds enrich
the crown.
Faith and toil.
Conquerless alliance, wherein we pass human hands unto God. In His control, find we through self-reliance, my hands and God's whatever yards, my hands and God's whatever yards, my hands and God's. Eagles unfold in defiance. Yay, St. Joseph's, but
Yeah.
come on, guys. Okay, Giri, it's over to you, and thank you. Thank Kanaga, thank you, Thomas, and most of all, thanks, Rajan. This is, Jimmy saying goodbye, but only for a short time. We'll be back in as soon as these guys have our next one ready to go. Giri, any closing comments?
That's about all. Thank you all for joining, and you'll hear more from us on the podcast. Thank you so much.
Thank you, and bye-bye.
Have a good one.
See you, Jimmy. See you, Thomas. See you, Giri.
Yeah.